Alright, you're welcome back. In this module, we're going to be talking about how to set up a trade, you know, how to set up a trade. And basically, we're going to be talking about top-down analysis, top-down analysis, okay? Okay, so let's quickly dive into this topic. Now, the very first step you want to take when you open up a chart, when you get on the chart of any financial instrument, whether you're trading currencies, whether you're trading stocks, whether you're trading metals like gold or silver, or you're trading cryptocurrency, it doesn't matter whatever it says you are trading. Start your analysis from the higher time frame. Okay, start your analysis from the higher time frame. The higher time frame includes a monthly, weekly chart, daily chart, and 4-hour charts. Those are the higher time frame that I use for when I actually want to start. So basically, I simply just start from the monthly. And basically, when I'm looking at the monthly, I'm also looking at the weekly, I'm looking at the daily, because the supply and demand zones of the higher time frames are usually very stronger than the ones that is actually happening on the lower time frame. So basically, you want to mark out your you know you want to mark out your zones from those higher time frame, though you're not going to be taking your entries on those higher time frame. But basically, what higher time frames does is to give us the clearer picture of what the institutions, the big institutions around the world, are actually doing in the market. Okay, we have a good understanding of what they are doing in the market. So when we start analyzing from the top, from the top chart, I mean from the higher time frame, from charts of higher time frames, the monthly, the weekly, the daily, and 4-hour charts. When we begin to look at it from the top like that, we actually call that kind of approach, we call it top excuse me, we call it top down analysis. Okay, so in case you are going to be day trading, because we actually have different kinds of traders. We have some traders that can hold a particular trade for days, for weeks, sometimes some even hold it for months. Those kind of traders, we call them swing traders. Okay, we call them swing traders. Of course, they make use of the higher time frames for their analysis. Higher time frames like the daily, the monthly, the weekly, and of course the 4 hourly. They actually make use, of those time frames, of those for their analysis. And of course, you know that it actually takes longer period. It takes longer for those kind of analysis to really play out. So they actually have all of the time. They can wait for weeks. I mean, wait for days for a particular trade to really play out. But we have some set of people that believes that, well, it has to be on a daily basis. I actually want to go into the market on a daily basis and see what I can actually make out of that market. So those are day traders. Okay, now if you are going to be a day trader, if you're looking for short-term trade, like day trading, more like you want to like approach the market on a daily basis. Okay, now you can look at 1 hour charts. Okay, you can look for 1 hour charts for your points of interest. Of course, your points of interest, I know by now you understand what points of interest are. You're looking at those areas in the chart that you know that satisfies all everything that we have discussed in zone qualification. If you don't remember all those points, please I will encourage you to go back to those videos and watch them all over again. Okay, so POI are essentially your demand and your supply zones. Okay, so you can actually mark out your supply and your demand zones on the 1 hour, on 1 hour chart. Okay, if you are looking forward to day trade, you can actually use you can use H4, that's like 4 hourly chart, and H1 as your higher time frame. Sometimes you can even use 30 minutes, sometimes you can use 15 minutes as your higher time frame. It depends on what's actually happening, on those charts. In as much they satisfy all the conditions of quick move, that's actually, quick and very strong move, you know, and of course you have break of structure, and of course you have freshness of that zone, and if there's risk to reward ratio is is fine. Why not? You can actually mark out those zones. If, I've actually seen traders marking out their higher time frame on, on 15 minutes, on 30 minutes as well. But of course, I think it's actually make a whole lot of sense if you're working with 1 hour, or, or H4, that's like 4 hour chart for your higher time frame. If you are day trading, okay, if you are day trading, all right, do that. Okay, so that's the first step. When you want to, the first step is for you to start from the top down analysis, to do the top down analysis. Okay, now the second step, when you are setting up a trade, the second step is to mark out supply and demand areas on the higher time frame. Now, higher time frame at this point is actually relative, depends on whether you're a swing trader or you are a day trader. Okay, or you want to scalp, all right, or you are a scalper. Now it depends on exactly the kind of trader you are, but it doesn't matter. It doesn't really matter the kind of trader you are. Just go on your higher time frame that actually suits the kind of um the trader you actually want to be, whether you want to swing or you want to day trade or you want to scalp. You have an higher time frame for each set of that category. So mark out your supply and demand areas on your higher time frame. And then the third step is going to be, you have to wait. Okay, you have to wait for price to retrace to your supply and demand area. Okay, when price returns to your demand and your supply area, there is no guarantee. Okay, there's no guarantee that that particular place we hold. That's why we have to use our entry protocol. Certainly we're still going to talk about that. So when price comes into that particular place, switch to lower time frame. you know Basically, I use 5 minutes. I use 5 minutes chart for my entry confirmations to confirm my entry. All right. you know so when, let's say for example, I'm using 1 hour as my higher time frame, just for an example, so I have marked out my supply or my demand area. So all I do is to wait for price to come to that particular, to that particular area, to that particular order block to come and mitigate it. So I don't just make entries like that. There are certain things I want to see. Okay, so what I want to see, I'm going to see it on the lower time frame, such as the 5 minutes. Okay, such as the 5 minutes. I use 5 minutes most of the time. Sometimes, of course, I can also use 1 minute as well, but in most cases, I use 5 minutes chart for my confirmation. Now, what does my confirmation look like? That is actually in step 4. Now, in step 4, I'm going to be waiting for change of character after price has come into that area, into that zone that I've actually marked into my OP for mitigation. Now I'm waiting on 5 minutes I'm going to be waiting for what we refer to as change of character on the lower time frame. That is actually the 5 minute chart. Now, what is that change of character? Now, you remember when we were talking about the structure of the market, that when you have when you have an upward trend, that you're going to be having series of higher highs and higher lows. Okay, that's when you are in a downtrend, you're going to be having series of lower highs and lower lows, right? Okay, now when, let's say for example, you have a demand area, all right? If you have a demand area, basically when price is actually coming back into that demand area, it's going to be, doing series of lower highs and lower lows, because it's going to be descending, into that particular area. So when price touch down into the area you marked, it must touch down into that area you marked. So when it touch down to that area you marked, and you simply switch your chart to that lower time frame, you want to see a break of structure to the upside this time around. Okay, because what is actually happening is that higher highs, I'm sorry, series of lower highs, lower lows up onto that your demand area. So in the lower time frame, you want to see a break of structure to the upside, telling you that now the price, that the market is now ready to to actually start going back to the, to the upside. More like, what happened that made you to mark the area in the first place as a demand area. You want to see the market do the same thing on the lower time frame. Okay, that the strong move that break the structure this time around to the upside. I think you just understand that now. The opposite is going to be the case when you are dealing with a supply. Don't worry. I just wanted to have an idea of what we're actually talking about when we're talking about that change of character. Okay. So what is going to be the next step? The next step is going to which is step 5. You have to mark out the order block that caused the break of structure on that um lower time frame. Okay, now price will certainly come back to come and pick your order. So when price comes back into that order block, that is when you are going to make your entry. Okay, you can actually make your entry at the proximal line, or you can make it at the 50% of that order block. The choice is actually yours. But like I said, that most of the time, price usually don't, not that usually, not always will price come into the 50% of that OB. All right. So not every time it will come into that OB. All right. So since it's not going to come to that OB almost every time, so you can as well, depending on, as much as depending on you, and of course, as you practice the more, you are going to decide what really works for you. But that is basically how it works. Okay. So I'm going to stop this particular one here, and in the next module, we're going to be talking more about the entry protocol. Okay, see you in the next one.